This is the History Lessons Podcast with certified financial planning practitioner Patrick Huey.
Genius or, not so much? Why is crypto down from its historic highs? That's a question a lot of people are asking when they look at charts right now. They remember the peak back in the fall and they compare it to the reality of today. Bitcoin has pulled back from its all-time highs. Many altcoins are even further off their peaks. And in the middle of all that, you're hearing about new laws and regulations, especially the 2025 Genius Act. So what's really going on? Well, in this video, I'm going to break it down into 3 layers. The big picture, macro environment and normal market cycles. The market structure, leverage, speculation, and how excess gets unwound. And then policy, where the Genius Act fits in, how it affects liquidity, and why it's an indirect but very real factor in the current drawdown. By the end, you'll see why prices are below historic highs and how much of that story actually belongs to the Genius Act. First up, the big picture, macro and market cycles. Let's start with the environment crypto is trading in, because no asset exists in a vacuum. When crypto was making historic highs, a few things were usually true. Global liquidity was abundant, or at least improving. Interest rates were lower, or expectations for rate cuts were strong. Risk appetite across markets was high. Tech stocks, growth assets, and speculative plays all were doing well. That backdrop matters when central banks either raise interest rates or don't intend to cut them in the future. Liquidity conditions tighten and investors become more cautious. In those cases, you typically see less demand for the riskiest assets, of which crypto certainly qualifies. You also see more demand for cash, bonds, and defensive positions, as well as a general cooling of speculative excess. Crypto sits near the far end of that risk spectrum for most investors. So when the macro environment shifts, even incrementally, from easy money and high optimism to tighter money and more caution, it's very normal for crypto to give back gains and trade below its highs. On top of that, markets move in cycles. Sharp rallies, consolidation periods, corrections, and then new trends. A drawdown from all-time highs is not unusual, especially after a strong run. So the first answer to why is crypto down would be market conditions are less supportive than they were at the peak. The market is in a corrective or consolidation phase after a major uptrend. And that's the backdrop for everything else, including regulation. So the first answer to why crypto is down is macro conditions are less supportive than they were at the peak, and the market is in a corrective or consolidation phase after a major uptrend. The second layer is how the crypto market itself was positioned near the highs. We're talking about leverage, we're talking about speculation. At or near peaks, you often see high levels of leverage in exchanges, aggressive use of derivatives, retail and institutional traders crowding into all the same trades. A lot of capital in smaller and more speculative tokens. Think about that. That structure is fragile by nature. When prices stop going straight up, a few things tend to happen. Leverage starts to unwind as margin calls and liquidations kick in. Traders reduce their risk, they close their positions, and they move to more stable assets. Liquidity in smaller tokens completely dries up, and it dries up faster, leading to sharper declines. Now, the process can take time. It doesn't always resolve in a single trade, a single crash. It can appear as a series of lower highs and lower lows with rallies that fade as sellers use them as an excuse to exit. So even without any new law, you would expect crypto to be sensitive to changing macro conditions because duh. And you would expect a market that was heavily leveraged at the top would suffer a meaningful pullback as conditions changed. That's the second foundational reason prices are down from historic highs. The market needed to clear the excess, as markets often do, in leverage and speculation. Now, on top of those two layers, macro and structure, we have policy. And that is where the Genius Act comes in.
GENIUS stands for the Guiding and Establishing National Innovation for U.S. Stablecoins Act.
Okay, this is a piece of legislation focused on the digital asset ecosystem with particular attention to stablecoins and their related infrastructure. It's important to be precise about what it does and doesn't do. Okay, here's what it doesn't do. The Genius Act doesn't ban Bitcoin, doesn't make owning or trading crypto illegal, and it doesn't shut down exchanges by default. What it does focus on is the plumbing of the crypto market, especially stablecoin issuance and backing. Stricter standards for who can issue stablecoins, requirements for higher quality reserves, audits, and disclosures, and yield and incentive structures. There are limits on how stablecoin related yield products can be offered, and there's more scrutiny of high yield, low transparency offerings. There's more compliance reporting. There's stronger AML expectations, that's anti-money laundering. There's more detailed reporting to regulators. Now, if all that sounds like a lot, it is. And that's because stablecoins are critical because they're the main, quote, currency for many trades now. And they're a key bridge between traditional finance and on-chain markets. It's a large share of on-chain liquidity. In other words, the Genius Act is aimed at the fuel and the pipes of the crypto system, not at Bitcoin's core code. But when you adjust the fuel and the pipes, the prices can and will be affected, especially in a market that's already dealing with macro headwinds and with cyclical come down from speculative highs. So how exactly does that connection work? Well, the Genius Act is best understood as the indirect short-term bearish influence, as well as a potential long-term stabilizer. Fingers crossed on that one. There are four main channels through which it can weigh on prices today. It can tighten liquidity, right? Stablecoins are effectively cash for crypto traders. If issuers slow down or change how they operate, or if some platforms reduce leverage or pull back on aggressive products, if new issuance is more cautious, then less speculative capital is going to be chasing those same assets. So in a market that's already off its highs, reduced liquidity often means rallies have less follow-through. There's less cash chasing those trades. Sellers can push prices down more easily. And volatility around news and data will increase. There's just not as much money flowing through to dampen out that volatility. So this Genius Act adds another constraint on liquidity to an environment where liquidity was already tightening due to macro factors. The new rules around stablecoins and infrastructure often hit the riskiest areas the hardest. When those are sold, investors often also trim positions in larger, more liquid assets like Bitcoin to rebalance the risk or meet redemptions across their entire portfolio. Also think about institutional repositioning. Larger regulated players, funds, trading firms, potential ETF issuers, they cannot ignore a law like the Genius Act. They have to review their strategies and products. They have to consult legal and compliance teams, and they have to adjust stablecoin liquidity and counterparty exposure. So during that process, new allocations may pause. Some existing positions may be reduced, and the order books can start to thin out, making those moves more abrupt. Can you say volatility? In a market already cooling from historic highs, this kind of pause and repositioning can reinforce the move lower or delay any strong attempt at retesting those highs. Tighter liquidity, a more cautious risk backdrop across all assets. It's a normal correction. But we also have stricter rules on stablecoins and yield products, and that's providing indirect pressure on liquidity, risk appetite, and institutional positioning. In the short term, this contributes to tighter conditions, more cautious behavior, a slower path back to previous price peaks, and more volatility. But in the long term, if it's implemented well, it can improve trust in key parts of the crypto infrastructure. It can make it easier for large regulated institutions to participate, and it can support a more stable foundation for future growth. So to answer the original question, crypto is down from historic highs because of a combination of macro headwinds, the natural unwinding of speculative excess, and policy changes, including the Genius Act, that tighten liquidity and reshape incentives. The Genius Act did not crash crypto on its own, but it did add some weight at a time when the market was already pretty vulnerable. If you'd like more breakdowns that connect macro, regulation, and market structure to what you see on your charts at home, consider subscribing and share in the comments how you're navigating this phase, reducing risk, staying patient, or looking ahead to the next cycle. I'm Patrick Huey, and that was 3 things on the crypto market. Thanks for watching.